Good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is September 9th. I hope you're doing well Saturday. I hope you're enjoying the weekend. I'm actually really excited this weekend. I know this will sound exciting to you guys, but there's a mortgage convention here in Vegas that I can't wait to go to. I don't think it's like the ones in Big Short anymore, but I get to meet with some of the wholesalers we deal with and things like that. So, as usual, I'm going to talk about my favorite things. I'm going to talk about the stock market, the real estate market. I'm probably going to ramble a bit about baseball cards because my brother and I collect this 1991 Desert Shield stuff, and we had an interesting thing happen that I'm curious how that plays out. Um, but I'll start with real estate. I like to watch. I like to watch this guy Jerry Abbott, who's here in Las Vegas. I like Michael Bordenero. I even like to watch Graham. I forget his last name, who's out here in Vegas too, because I find them all interesting and entertaining, as well as Nick from Reventure. But and then this guy Orlando. But I think he's a little bit off his rocker. And then I forget the other guy's name, but he constantly goes, "It's bonkers" when he starts his videos. Most of these guys are a little bit negative on the market, and I don't normally like to mention the names, but I like their videos, so I don't want to be too hard. And they're very data driven. But the thing is okay, let me talk about some of the data that I was listening on Jerry's video this morning. He puts them out every Saturday. Again, I really like Jerry and I like the things he talks about, but he was talking about the affordability of the example he was using was a $600,000 home, showing that you need to be making a little over $13,000 a month to qualify. I think he was showing that they were putting about 6% down at a 7% interest rate or so was the example he was using. And that to qualify, you need to make a little over $13,000 a year. And then he said the average income of an individual is 55,000 a year. So how is it possible? Like who can qualify for that? Well, let's take that into context of it's a $600,000 home and he's using an individual's income. Well, if you're looking at a $600,000 home, what I'm picturing in my head is it's probably not one person buying the house. I would expect it to probably be two. So if you double that salary and you're at 110, you're not as far away as he'd like to make it sound. On top of the fact, a $600,000 home to me isn't like a starter home that an individual at the average salary would probably be considering. Uh, don't get me wrong, it would be great if everybody could, but life isn't always so fair like that. And it's just not what I have pictured in my head that an individual making the median salary should be considering a $600,000 home if they want to be realistic about what they can afford. Um, then he has some examples of price reductions that new home builders have made, which maybe they got a little ahead of themselves, but the new home builders have a really good gauge of how much supply and demand there is. They know their inventory and they see the buyers coming in and how it ebbs and flows with the market. Well, they've dropped their prices based on what he was showing, anywhere from 10 to 20%, and they're giving a little bit of incentive money as well. I think that's pretty reasonable for where we are. I mean, the market really has slowed, and it's at this bit of a weird position where it's really stagnated a lot. And to be fair to the ones that are negative, I could see some price reductions, and I even see interest rates potentially coming back down. I just don't see this big collapse they're talking about because we don't have the same loans in place that we did before. I've talked about this a few times, but let's go back to 2006 and 2007, where they were using a product called the option arm. It gave you different options of payments you could make, and most people would take the smallest one, which typically, even on like a $800,000 home, was probably in the hundreds of dollars per month. But then those loans matured. They typically had a 5-year seasoning period where you can choose the option of what payment you could make. So you could pick this negatively amortized one. You could do one that was interest only. You could do one other as well as a fully amortized payment. But when they matured into a full normal mortgage payment that you and I probably think of, which includes principal and interest. So if you were paying $700, now typically the increase in payment was 4 times the amount of what that other payment was. So if you're going from six, seven, $800 a month to 18, 24, $3,200 a month, and there's been a hiccup in the market and you haven't paid any of the principal. So when you're paying those minimum payments, you're not paying down on your house either. You've owned it for 5 years. You haven't paid any of the equity down. If the housing drops a little bit, let's say you bought a $500,000 home and it dropped just 10% in the beginning. Let's say it's now worth 450, but you might have done a first and a second because they allowed for that back then, where you really didn't put any money out of pocket. You might still owe the full 500,000, but if you did the minimum payment, my God, you might have owed 510, 520, 530 by the time those 5 years elapsed. The house is only worth 450, and now your payment just quadrupled. That's a much different scenario than the market we find ourselves in today. You go today where, what did they say? 80% of loans are under 5%. These, I'm estimating, it's just off of memory. Something like 60 or 50% or under 5%. Maybe it was 6% that 80% were under. And something like 30% are still below 4%. Well, if you're in those ranges, even if housing prices come down 10% or 20%, on top of the fact that it's gone up pretty significantly over the past few years, you might still have a good amount of equity in your home, but your payment isn't quadrupling. And if you wanted to move, you're probably looking at a higher payment on a smaller house if the rates have gone up and the prices have gone up from where you were in originally. It's quite possible we have some price reduction, but it's also possible we don't. That's why I say be careful where you're listening and what you're getting from the people, because I don't see that big collapse coming from it. Even the Airbnbers. Let's talk about New York, where they just changed the laws dramatically. I mean, legitimately dramatically. My understanding is the owner of the property actually has to be in the rental, which is kind of crazy, period, because how many Airbnbers or owners really want to be in that situation? You have to be licensed properly and so on and so on, or Airbnb won't even take the reservation. That doesn't necessarily mean that all of those properties are coming back to the market. Most investors are pretty well capitalized. It just means they have a decision from this point. Either they'll look to long-term rental, maybe some of them were using it part of the year or not. Maybe they do sell them. I don't know, but I don't see it being any big calamity to crush New York real estate market, nor do I picture that being the case anywhere else, even if they pass laws like that in other jurisdictions. You know, I don't see this big influx the way that the other people touting on YouTube do. You also have situations where big corporations are working deals with the builders where they're buying out an entire development so that they can just do it as a rental property. Really interesting stuff. And I think they're just basing it off of how much money out of pocket, what do we think we can get on return and investment, and where else is the money better off. Again, prices might come down. I just don't see it being real dramatic. And I would hate to recommend somebody not buy, because if they don't go down and they continue to go up, they're staying out of the market that's constantly moving. Feel the same way about stocks. Maybe some are overvalued, but some are always undervalued as well. And whether the economy is slowing or whatever's going on, and I think we are slowing, there's still going to be good stocks that go up in a slowing environment. I'm not a financial planner. Ding, 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 disclosure right now. Don't listen to my advice. I'm just some moron on YouTube. By all means, reach out to your financial advisors or whoever you do and make your own decisions on any aspect of that. Just don't. This is entertainment only. I talk about the things I do. You know, I like some of these boring old stocks right now. I think Pfizer's rather cheap, and they've lowered earnings a few times, so they're slowing down. But to be fair, when I look at how much they make, they're still doing just well. And even if they hit those lowered targets, well, earnings are decent on a price to earnings ratio from what I see, and they pay a 3.5 or 4.5% dividend. So I like a stock like that. I still think Meta's cheap as much as it's run up. And those of you who hate Nvidia, I think it's at a fair price, even after the run up it's had. They're crushing it in terms of earnings. If you do their PE ratio based on the last 2 quarters and take off the two before, because it wasn't when they were selling this chip that they've created, as their research and development costs have gone down because they've already created the chip, so they don't have to spend the money to figure it out. They're actually probably at, you know, 35 times forward earnings and maybe 40 or 50 times now. Well, if they continue to produce at the level they're producing and continue to grow at the pace they're growing, they're not going to hit a 15 or 20 PE. And by the time they do, well, you probably don't want to own it anymore. You want to own it while they're continuing to grow. I don't think it's so crazy priced, even though it's had a big up move, which means there's a big difference between a bull market run versus things being overpriced. Feel the same way about housing. Maybe there's a pullback, but I still think we're on the way up. And if the Fed's done a really good job, which I have my own concerns that they'll go too far and push unemployment further than we think, but if they've done a good job, well, there's a good possibility that we slow a bit, they can start cutting rates, and then we catch and continue having a strong economy. Markets tend to go up when there's nervousness. When there's finally no nervousness and everybody's getting into the market, that's generally a sign that we've gone too far. I call it my doorman test, and forgive me, I don't mean anything rude by it or anything else. But when I remember back to the internet bubble, I lived in Chicago in a high rise, and so did my two best friends. They both lived in a high rise as well. Well, when I would go to visit or when I would come home, the doorman would be like, "Oh, which stock did you see today? Did you see this one or that?" And it was always some .com whatever. By the time everybody is talking about it is when the markets have gone too far. Well, I don't see that right now. I don't go to a hotel and the bellman say, "Oh my God, did you see the housing market is taking off? Oh my God, did you see the stock market? Did you see this stock or that one?" Most people have been hurt by it and not really involved, which is a little bit why I think we keep chugging along, scratching our heads going, "I don't understand. It should correct. It should correct." That can go on for years and years and years, which is why I worry about advice of don't buy. I'd much rather you buy something too small that you don't picture as the house I live in forever, but have something in, than just sitting and waiting. Because if I'm wrong and there's a correction, you bought something that's easily affordable, and hopefully you have a job that's secure and you don't worry about those payments, so that it's in line. And if the prices fall, it doesn't hurt too much. And now maybe it puts you in the position that, yeah, you can step up and buy something a little bit bigger that was what you wanted to begin with. I never advise going out and pushing your debt to income levels to the furthest possible point and being overstretched. The only time you do that is if you have a spouse that has a job that we can't use the income, or if there's something else going on where you're really not so stretched, it just might look that way on paper. I wouldn't want to be that stretched on anything by that matter. Now, I promise I'd talk about these Desert Shield cards because I like all sorts of collectibles, even baseball cards. Back in late 90s, early 2000. Like, I remember when these came out. They were so cool. It was one of the first special edition sets that ever came out, and it was done by Topps for the troops, and it went out to them just in packs. So they were really special cards, and my brother and I always remembered them. They were worth a ton of money, and then they fell to being worthless. And when they were pretty much worthless, we picked up a bunch because we found it interesting. Over the years, by trading them, what we've learned is a lot of vets collect them. So we'll sell them on eBay and we get in and out of the market. And really, when somebody who was obviously really a vet reaches out to us, we're overly generous with them because we love that, and we like to support that. Maybe they were there and they remember them when they were. Anyway, PSA becomes this grading company of the cards, and they make some of them more valuable than others. we had one, and we always talk about what happens one day when people are able to counterfeit these things easier and easier. Well, the most popular card in the set is Chipper Jones because it was his rookie card. We have a really well graded card, and it got flagged as potentially fraud. So I'm curious how it plays out. We're supposed to reach out to PSA to see what they say about the card, but they're supposed to be the authenticator of these things to note that they are legitimate. So if it is an illegitimate card, I'm curious what PSA does about it and want to kind of see how it plays out. As it moves along, which will take a long time, I'm not going to update that often. I'll update when I get more information, but really, I kind of wonder, does PSA get us another? Do they honor it? Do they pay us what they value the card at? Or do they just say, geez, we made a mistake, sorry, you lose? Um, Anyway, I hope you guys have a great weekend. Keep watching. Watch those other channels. To be fair, even though I disagree with most of those guys on a lot of the data points, I wish I remember his name. The guy who says bonkers. To be fair, he's got some really great suggestions. One about putting down some money right off the bat to pay off principal once you get into a house. I thought that was really smart. Um, there are a lot of things he says that I disagree with. Like, I think he's renting right now. He got out of the market because he sees a collapse coming. I always think that's a mistake. You just don't overbuy. Don't put yourself in don't put yourself in a spot where you won't be able to afford something. Underbuy whatever it is so that you're always in the position to be able to afford it even through the downturns. But I want to own things for 30 or 40 years. And before I go, if anybody's watched this far, and if you've watched this far, do me a favor, subscribe, like, give a thumbs up, tell me why I'm an idiot, all of those things. But I'm going to tell a story I've told before, and I'll try to fly through it because I know I'm already 20 minutes into my video. But I've been really fortunate a lot. But when I was, God, I must have been 16, 17, I was barely driving. My grandfather was getting older, and he gave all of his grandkids a gift because he wanted to see us enjoy money before he passed or before he got too old to see it. And he gave all of his grandkids $10,000, which was a ton of money in the mid 90s. I graduated in 94 and I was like a sophomore, so it had to be like 92. Um, Actually, no, I graduated in 90, so it had to be like 88. I graduated college in 94. So my mom took it from all of us because it was too much money and she didn't want us to go buy a motorcycle or do something stupid. And there are 5 kids in my family. And I went to my mom and complained. She's like, why? What do you want to do with it? Well, even at that age, I wanted to buy stock with it. I bought 5 different companies. I put 2,000 in each company, one being McDonald's. The other 4 all went out of business, or like I sold my Chrysler for $9 a share because I wanted to buy a computer for school, and I used the $900 to buy a computer. GE was one of the others. Well, the reason I tell this story is that $2,000 in 1988, that McDonald's was already McDonald's. People had stories of their grandmother or great grandmother that put $1,000 in McDonald's, and my God, she left it there and they were millionaires because of it. It wasn't some new fangled company. It was what I think of as the big companies now, the Apples, the Facebooks, the Googles. Like, it was a legit company, but so was GE and Chrysler and the other ones I picked that all, Eastman Kodak, that all went out of business or went to pretty close to being out of business. But the 2000 that I put in McDonald's, the stock has split 4 times since. I don't still own it. I wish I did. It's also close to $300 a share if I remember right. Well, my 100, 200, 400, 800, 1,600 shares at 300. So the 1,000 would be 300,000. You add the 600, it's another 180. Well, like $480,000 on my $2,000 of shares. Now, even if I was off one and I only had 800 shares, and I think I'm right about the 4 splits, but let's say it was 3. Well, we're still talking about 250 grand over the past 30 or 40 years from a $2,000 investment. Even call it the 10,000 that the others went to wherever they went. From 10,000 to $250,000 over 30 years or so. maybe 40. That's why I say you want to own them and own them forever. Whether it's a stock, whether it's a house, whether it's baseball cards. Inflation is real, even though we're all feeling it more now, and the stock should outperform. And even if you have ones that fail, if you spread out a bit and go into a variety of good companies in the long run, you should do really well. You just don't want to be getting in and out. And I'll tell you something even more interesting. During those time frames, McDonald's fell in half like 3 or 4 times. So there were these big scares where the market cap of the company dropped in half or more. But if you just dealt with it and stuck it out, it works out. I believe that in my heart of hearts about good companies. I think if you stick with it, you'll do just fine. Anyway, I've rambled a really long time. I hope you guys have a good weekend. I hope this gets some views. Again, thumbs up, like, subscribe, and make some comments. Tell me I'm an idiot. I love to talk this stuff. I love markets. I love all of it. Have a great day.